Um, Good afternoon, and thanks for joining us. I'm Chris Kamak at FxScouts, and I'm joined today by my lovely colleague and co-conspirator and all-round excellent Forex trading educator, Alison Hayerdal. Hey, Alison, how are you today?
Hey, doing very well, thanks, Chris. Yeah, and we are very happy to have Michael Brown with us too, the senior research strategist at Pepperstone. So thank you so much for joining us, Michael. We really appreciate you being here.
No, my pleasure. Very good afternoon to you both. Good afternoon to our viewers, and very happy Friday to everyone as well, of course.
A very happy Friday afternoon. I hope wherever you are, you're enjoying your Fridays. So, just a brief introduction to this live stream. We're at FX Scouts. We've just published a Q3 Global Forex Market Report, just looking back over the third quarter. And there's some ideas in there about where we might be going in Q4 as well. You can download that in the description underneath this YouTube stream. And we thought we'd have Michael on. Michael, you were on and we were talking in May, and about the outlook over the summer, and we thought we'd get you back on because it's been quite an extraordinary summer, and it would be nice to get some of your perspectives on what's been going on and where you think we're going to next in Q4.
Yeah, absolutely. I mean, I think extraordinary is probably the only way to phrase it. To be completely honest with you, I'm loath to revisit some of the calls I made in May because they didn't age particularly well. So what we were talking about earlier around how we were both quite confident that Trump wouldn't try to erode the Fed's independence too much, and instead we've had an attempt to fire one of the governors, placing his right-hand man on the board, and daily protestations around lower interest rates. But
I know.
there we are, something to keep us on our toes, I guess.
Yeah, no, indeed, it's been extraordinary. I mean, especially when we came into July. I mean, we saw the DXY, the dollar, had fallen. I think it's almost unprecedented, the largest since 1973. If we have a look here, I think we've actually got a graph here showing the 1973 versus 2025 fall in the dollar. And that in 1973, I was looking back. I'm not a huge historian myself, but I was looking back, and that's when the Nixon administration intentionally devalued the dollar by
Yeah.
about 8%. So without this intentional devaluation, we still saw this fall. So coming into the third quarter here, we had a seriously almost unprecedented weak dollar, and it kind of, but then everything started changing.
Yeah, it's an interesting one. I think, frankly, what we saw in the first half of the year ultimately was a market that was just very, very spooked by what the Trump administration were doing.
Yeah,
Whether that would be trade policy, fiscal policy more broadly. I think just in general, it was a case of we have a much more volatile administration and a much more uncertain economic environment than we have had in the 4 years preceding that when Biden was in charge. And the market
yeah,
really struggled to react to that. And I think probably the majority of investors, their natural reaction was, actually, I just don't want to have to worry about this. I'm just going to come out of the dollar entirely. And that's why we've seen these big inflows into things like the euro, into things like gold and other precious metals as well. And I think as we came towards the beginning of summer, kind of July, August time, a lot of that, it just seemed like that bearish trend was suffering from a little bit of exhaustion. We'd come through the initial uncertainty around tariffs and we're starting to see trade deals being agreed. Of course,
yeah,
we had the European Union, Japan, etc., agreed during the summer months. And I think it just allowed market participants to take a bit more of a pause for breath and actually reassess things and move from this kind of initial panic stricken mode that we saw in July to, before July, to a slightly more rational mindset, which we then saw prevail throughout the summer. And obviously, the dollar's been on the front foot a little bit over the last week or so as well.
yeah, yeah, exactly. And then, I mean, but we also, there was a lot of volatility throughout the summer, as you say. So we saw this a rebound in July, and then we saw particularly I think the big shock, I think for a lot of people was August 1st NFP. We can see here, which is when that clicked in. And so everybody before this point, people have been saying, oh, hey, look, I mean, the US economy seems to be doing all right. It's quite resilient. The dollar's all right. And then all of a sudden we get this huge jobs market shock.
Yeah,
Yeah.
and you're right. It was a big shock, and of course, since then we also had the benchmark payrolls revision, which was earlier this month, which was obviously down 910,000 or whatever, and actually meant that job creation in June was negative. Now, I would say there's probably a couple of ways you could look at this, and understandably, when the the July payrolls print came out at the start of August, the way everyone looked at it was, oh my God, the labour market is nowhere near as resilient as we thought. Payrolls growth way down, 200 odd thousand downward revision to the prior data, etc., etc., etc. I think you can either look at that as structural weakness in the labour market and a sign that the US economy is really at risk of rolling over in quite a big way, or you can look at it as a labour market that needs to adjust to probably a decade's worth of policy changes, which happened in the space of about 6 weeks in April to mid-May. Yeah. It's a labour market that's coming through that in a similar way to what we would see if a significant natural disaster like a hurricane, for example, hit the United States. We see an adjustment in the labour market, employment growth falls off, but then it recovers because it's not a structural issue, it's just a one-off sort of bump in the road. So I think that's kind of the fork in the road we're at now, whether you're a market participant or whether you're a policymaker at the Fed. It's going, we've had 3 months of weak jobs data. Is that 3 months of adjustment, things are now starting to bottom out and we're going to recover again? Or is that 3 months, which is a warning sign that actually the next 6 could be even worse? Personally, I come down in the former camp. I think the Fed are worried about the second outcome, which is why you saw that relatively dovish FOMC meeting, well, last Wednesday it would have been.
Yeah, exactly. Go on, Alison.
Sorry. No, and would you say, the investor confidence in these US institutions, the Fed and the BLS, the Bureau of Labor Statistics, also play sort of into the fundamentals and driving the dollar moves?
Yeah, I think for the time being, certainly the Fed, I think the BLS is a slightly different kettle of fish, given that the new commissioner is sort of puppet of President Trump. But I think by and large, the Fed is really what matters. And I think by and large, the Fed have been very, very good at resisting a lot of the political attacks and the political interference that has been going on there. So I don't think investors are necessarily too worried or too panicked right now about monetary policy independence being lost. Having said that, we are probably the closest to that independence being lost, certainly that I can remember in a decade or so in financial markets, and you can go back way longer than that as well. Obviously, if you've got on the screen there, Lisa Cook, Trump is trying to fire her over these trumped up allegations of mortgage fraud. You've got Steve Moran, who's now on the Fed board, but is also the chair of the Council of Economic Advisors at the same time. Chair Powell's replacement, whoever that's going to be, you'd imagine that's going to be someone who frankly puts loyalty to Trump above any sort of macroeconomic qualifications for the job. So we're certainly moving to a world where the Fed is less independent. But I think the important thing to remember is, despite those three things, which are very, very significant developments, it is still the fact that monetary policy is set by consensus. It's set by a vote among 12 members on the FOMC. And we see that right now with Steve Moran coming in, dissenting for a 50 basis point cut in September, putting his dot in at 125 basis points lower than everyone else, and talking about how they need to cut rates by 2.5 percentage points. No one else on the Fed is of that view. It's very much a sort of lone wolf saying that. So I think, yes, policy independence is waning, but it's possibly not quite to the degree that we were panicking about earlier in the year.
Yeah, absolutely. And I mean, in a similar vein, I mean, and something else that kind of speaks to investor confidence, because I mean, as you say, like, I mean, we're not worried immediately about the Fed losing its independence at the moment, but it is the closest we've been in some time, and there is this sense of gradual erosion and anxiety amongst investors. But we are seeing this extraordinary bull run in US equities. So even as the dollar has fallen this year, we've seen this huge amount of capital going into US equities. I mean, what do you think is going on there? I mean, what are we seeing? Is there any kind of precedence for this?
Yeah, well, I mean, it's a staggering move, frankly. Certainly considering where we were in April, where the S&P was down, 15, 20% in the space of a week after all the tariffs were announced on Liberation Day. I think fundamentally, when you sort of strip away a lot of the nonsense and the political rhetoric, you're looking at a market where underlying economic growth is very, very resilient and very robust. And we saw that yesterday in the GDP numbers out of the United States. We've got a market where earnings growth is very, very solid indeed as well, not only in terms of the tech sector, but actually the market at large. And one of the sort of misconceptions about the rally this year is everyone's going, oh, well, it's all tech, it's all tech. Well, it's not, because NVIDIA are the best performing Magnificent Seven stock this year, and they're not even in the top 50 in terms of the S&P's best performing stocks this year. So the rally is actually relatively broad. You then add on top the fact that certainly compared to where we were in April, the tone and the overall rhetoric in terms of trade is much cooler. It's much calmer now than it was around the sort of peak concern of Liberation Day. And then, of course, over the last sort of 4 weeks or so, you've had the extra helping hand from a Fed that is, or a market that's pricing a much more dovish outlook for the Fed, but also a Fed that has implicitly sort of said, okay, that's fine. We are happy to lean in and support the labor market and support economic growth. And effectively, the Fed are going, we want to run the economy hot. Well, the economy's already pretty hot. The market's already pretty hot. You want to run it even hotter. I think you've got to be pretty brave to be bearish here. I know there's always that, I don't want to be buying an all-time high, but, momentum begets further momentum. And at the moment, there doesn't seem to be any stopping it.
Yeah.
There was a good article in the FT the other day, actually. Katie Martin, who writes a long view for them, fantastic, taking some Deutsche Bank data, which I just wanted to bring up on screen here. And their explanation for why we're seeing what we're seeing here is that they're seeing a huge amount of hedging on an extraordinary level taking place for foreign domiciled inflows into US equities. So even though people are still buying, as you can see here in the S&P, huge amounts of US equities, there is now very much a distinct hedge against the dollar. There is this kind of touching back on what we were talking about, investor sentiment, investor anxiety. There is, I think, an underlying anxiety here in the US and the strength of the US economy.
But this also, I think, speaks to a kind of broader theme that we saw earlier in the year, where the run up to the 2nd of April and the 2nd of April itself really shook confidence in the US economy and the US as an institution. And you saw not only capital coming out in terms of looking for a haven in the euro or gold or whatever, but also in terms of equities. Institutional and international investors have been massively overweight the US for a decade and a half. Yeah. They then started to massively trim that back. And I think what the chart here is showing that actually, they are sort of slowly starting to tentatively dip their foot back in the water of the US equity market again, but they want to hedge their FX risk because they're maybe a little bit scarred by what happened earlier on in the year.
Yeah.
And do you...
Sorry, go on, Alice.
Sorry, I was going to say, do you think it's also to do with the fact that maybe the effects of the tariffs haven't been felt yet?
Yeah, I mean, this is a very, very difficult question to answer. And I think there's a number of issues with it. The first is, we all knew that tariffs were coming. We didn't know what the tariffs would be, but we all knew they were coming, which meant that anyone who was importing into the United States is going to try and front run those tariffs and import as much as they can before the tariff is put in place, throw that in a warehouse and just have that as inventory. So partly the reason you haven't seen the full sort of pass through of tariffs is because people are still selling down the stock that they bought at a pre-tariff rate. The second issue that you've got is that the tariff percentage or level or levy, whatever you want to call it, has changed so many times over the last 6 months or whatever it may be. You think about the European Union. On Liberation Day, it was 30%. Then it was paused. Then it was 50%. Now it's 15%. Plus any other sectoral tariffs that are on top. So, it's very hard to gauge the actual pass-through of these tariffs purely because, and this is where I'm a little bit reluctant to sort of fully endorse what the Fed are saying around a one-time shift in the price level. Because yes, ordinarily it would be. If you put a tariff in place today, it shifts the price level and then the price level stays where it is. The problem is you put a tariff in place today, you put a different one in place yesterday, you did a different one last week, a different one last month, which means you almost end up with this sort of rolling tariff-induced inflation, which is much more of a difficult problem to manage from a monetary point of view, but also much more difficult from a strategy point of view to actually gauge what's being felt in the economy and what isn't.
Yeah, and it's still ongoing. I mean, it's just today. Was it last night? Trump announced 100% tariffs on pharmaceuticals and branded pharmaceuticals. As you say, there's always seems to be that feeding into it, and it's not just tariffs on consumer goods that's coming in. I think it's something really important. A lot of people don't understand is that this is tariffs on supply chains as well. There are these huge supply chains that are just having extra costs built in almost at every step of the supply chain. I mean, the automobile industry in the United States, I think I was reading somewhere, I think a car moves back and forth between Mexico, United States, and Canada 7 times before it's finally built. And at every stage there, you're going to be having extra costs. And so far companies have been picking up the slack and consumers have been minimized. But I agree with you. I think, well, maybe not, don't want to put words in your mouth, but I do think that we may be seeing, that we haven't seen the full effect of this. And then I think when it does come through, I think it might be a lot worse than people think.
Yeah, I mean, very crudely, there's sort of 3 ways that the tariffs can be paid. Either the exporter can pay them. Mm-hmm. Don't think they will in many cases. The company who's importing can pay them off their own back, which means that naturally they're going to operate with narrower margins, and margins aren't particularly wide in a lot of sectors anyway. Or thirdly, that cost is just passed along the value chain to the consumer. I think probably at the moment, roughly you might have had a third of the tariff cost passed on to a consumer. I think the question is, as you move into the back end of this year and also into 2026, do businesses get to a point where they go, we actually can't absorb this cost anymore? We're going to have to raise our prices to compensate for that. I think that's the dynamic to keep an eye on.
Yeah, and I think that's when the Fed, it gives the Fed a very difficult problem. Especially if they're in the face of a weakening labor market. But sorry, just let's come back to that. I mean, I do want to talk a little bit about another big theme I think over the summer has been central bank policy divergence, because we've talked a lot here about the Fed, but at the same time, simultaneously, we've seen the ECB, European Central Bank in Europe, saying that they're done with rate cutting. They're completely fine with it. How much do you think that has played a part in what we're seeing in these price charts?
Well, I think it's played a significant role in it. I mean, as you say, the ECB are effectively done and dusted. I think if growth were to weaken further, then the ECB would ease again. And also if the euro were to strengthen too significantly, they've sort of flagged that 120 mark as a bit of a line in the sand. Yeah. If we get up there, then they may ease again. But I think, frankly, the ECB are done and dusted. So that did drive a little bit of euro strength, June, July, when they were indicating that. But actually, I think the market, is now looking at things through a slightly different lens, whereby actually ordinarily you would say, okay, well, there's a dovish Fed and a relatively hawkish ECB, euro dollar should appreciate. Well, actually, that's fine. But if the Fed are being dovish to lean in and support the labor market and to support economic growth, all of a sudden you've got an outlook where in the US, the economy is growing at 3.8% annualized quarter on quarter in Q2. Risks to that are tilted to the upside going forwards because you've got that powerful monetary support. In Europe, you've got a central bank which is effectively saying we're done and dusted. Growth is already pretty anemic. You'd kind of argue it's tough that growth is going to get better in Europe, given the structural issues that are well discussed. So almost you've got a central bank divergence, but I think the market is more focused on the relative growth divergence at this point, which is why we've seen the dollar rallying over the last sort of week, 10 days or so. And I'd expect that to probably continue in the fourth quarter as well.
You expect the dollar? You expect the? Well, let's get to that. It's not. We'll do Q4. We'll do a bit of a Q4 outlook towards the end. I did briefly also want to touch on the USD JPY as well, because that was quite interesting, because there was some political instability in Japan recently, earlier this month, but the build up to it as well, that has made what is and we can see here looking at the chart. I mean, it's just kind of ranging, obviously, most of the time. But what's your outlook? I mean, I know we have this political instability in Japan, and that the governor of the Bank of Japan has said, look, I would like to raise rates, but I'm probably not going to. He hasn't said it, but he's basically until we have some kind of political stability, I'm not going to. What's your outlook there?
I mean, to be honest, it is getting slightly comical at this moment in time. The BOJ are desperate to tighten policy further. Yeah. There's always a reason for them not to. I mean, you mentioned the political instability we've got now with the LDP leadership race going on. Yeah. We had another bout of political stability in July when we had the upper house elections, which obviously led to the resignation that we've seen over the last few weeks. Once that was out of the way, we then had the US and Japan trying to negotiate a trade deal. You've then had that out of the way. Then we've moved into this latest bout of political instability. And now we've got data that's actually starting to turn against where the Bank of Japan would want it to. We had quite a soft inflation number out of Tokyo this morning, which tends to lead Japan more broadly. We had real wage growth revised down into negative territory again as well. So I think the market has kind of got to the point with the BOJ where it's really a show me story. And what I mean by that is, we know you want to hike. You keep saying you want to hike. You keep saying if the outlook is realized, you will hike. Fine. Well, actually go and do it. And unless you do it, I've struggled to see the yen firming significantly, because we seem to have a Bank of Japan that wants to reach for any and every excuse not to pull the trigger. And I think we're at the point now where the market is essentially just going to call the BOJ's bluff on that one.
Yeah. Yeah, exactly.
Go ahead, Alice.
Yeah, I was going to just talk about sort of bring it back to the Fed again. So despite the September rate cut, Powell, in recent days has been making, well, you say dovish noises. I think people have been interpreting it quite differently. I guess he's sort of undecided at the moment, whether it's dovish or hawkish. But yeah, he's in a very difficult position, as we know. How do you think traders should take his words at the moment?
Well, I think I'm a very big fan of Jay Powell. I think he's done a very, very good job at the Fed over the last 7-8 years now. But I think communications around the recent rate move have been clunky and probably a bit clumsy, to be completely honest with you. The Fed are trying to walk a very, very delicate tightrope, whereby on the one hand, they want to ease in order to support the labor market, which is clearly weakening, but they don't want to signal that they are unduly concerned about the labor market weakness, because that would lead potentially to a degree of panic among market participants. At the same time, they are clearly putting inflation on the back burner at the moment. They're looking through that as a sort of one-time increase in prices. Yes, we've been there before after COVID, but let's hope we don't have a repeat of that. But at the same time as that, they're trying to ensure that what they look at, which is longer run inflation expectations, remain well anchored. Now, the problem with that is I've named 4 things there. 2 of those require them to be relatively dovish. 2 of them require them to be relatively hawkish. Yes. So I think what I've sort of done over the last week or so is we've had a ridiculous amount of Fed speakers. Yeah. Personally, I'm not paying particularly much attention to what any of them are saying. And I think this is very much a case of actions speak louder than words, which is you look at what's going on. Growth is running at 3.8%. Inflation is running at, as near as makes no difference, 3%. And unemployment is at a cycle high, and the non-farm payrolls numbers are well below the break-even rate. What are the Fed doing? They're cutting rates. And they didn't only deliver a cut in September, they also indicated in the dots that they're going to do 2 more this year. So to me, that's a Fed that's going, our reaction function is the labor market. The labor market is weakening. We are cutting rates. The price they're going to pay for that is higher inflation, but they've acknowledged that in the SEP. If you look at the latest projections, faster growth, lower unemployment, higher inflation. So I think, the way that I'm kind of playing things at the moment is almost not really focusing on what the Fed is saying. They're as data dependent as we are, but I think it's going to be very, very difficult when we get to the October meeting at the end of next month. If the data backdrop still looks kind of like it does now, the path of least regret for the Fed is just to deliver another rate cut. I think that's kind of the equation we're playing at this point.
I mean, what do you think that means for? Sorry, Q4, Q4 and the US economy?
Well, the actual action of delivering a cut probably won't mean anything in terms of financial markets, because we've got, just looking here, 41 basis points of easing priced in by year end. Oh, you've got it on the screen there. That would have been an easier way to look at it, wouldn't it? But we've got such a significant degree of cuts priced into the curve already that, again, if the Fed don't deliver those, the risk is on the other side, that you'd end up with an unwarranted tightening of financial conditions, which could further put the brakes on the economy. I think really the question now, and the problem with this is you're not going to get an answer to this question, because the question is, where does the Fed funds rate settle and when does it get there? We kind of assume neutral is 3%. When do we get there? It will be some point in 2026. The problem with that is Jay Powell has 5 meetings left as chair. We know he's going to cut at 2 of them, namely October and December, I would imagine. The next 3 at the start of next year, we'll know who his replacement is by that point. So I think there is a high degree of certainty around what the Fed will do this year. Next year is very much anyone's guess. And I think as a result of that, as long as the Fed deliver the rate cuts the market currently prices in, you are probably going to end up with an equity market that is relatively content with that looser monetary backdrop.
Yeah.
Very good.
I know you've got to run in a few minutes, Michael, and I do want to have a quick wrap up and thoughts for Q4. But before we do that, I just want to talk about this. I know, briefly. I mean, what is this saying? I mean, I know we've been talking here about investor sentiment and anxiety and growth and where, I mean, this says to me that people are worried.
Yeah, I think having an exposure to gold at any time makes sense. Having an exposure to gold now probably makes more sense than it has done in a hell of a long time. I think the sort of reason for this rally and why I expect the rally to continue can be surmised very simply as there is insane amounts of physical demand from reserve asset allocators who are going, I don't want to just hold everything in dollars now. I want to diversify that. And incidentally, that's not new. That's been going on actually since the start of the Russia-Ukraine war, of all things, when Russia's reserves were seized and any sort of bad actor went, well, I'd rather have it in something people can't seize if I'm planning something slightly nefarious. At the same time, you've got the risk of inflation expectations becoming unanchored from that 2% level that we all target. And then, of course, perhaps most importantly, and we sadly sitting here in London, we all know this problem only too well here, you've got governments that are basically have no control over the fiscal standing of their economies, whether it be Europe, UK, US. Government spending is at an insanely high level and it is going higher. And as a result of that, you put those 3 things together, you go, how do I hedge it? Well, you own precious metals. And we've got gold here, but also you look at something like silver trading at $45 an ounce. That is on an absolute tear at the moment. And it's difficult to envisage that bull case erasing itself anytime soon.
Yeah.
So you see this continuing. I mean, I think we all do. I mean, as long as, and I think it's something you touched on there quite briefly about, the fiscal uncertainty and the fiscal risk attached to, and it's something I think, I mean, and it's really the backdrop behind a lot of Trump's political pressure on the Fed is that, he's well aware that the US debt is through the roof. And if he can bring interest rates down, it brings his own bill down. But then, you touched on it there in the UK as well. The Labour government is really grappling with this, and I think it's going to burn the pound going forward.
I would agree. I see very, very little reason to be long of sterling, and I certainly see no reason at all to be long gilts, which are obviously UK government bonds. I think the 30-year trading at 5.5 is probably going to get up towards 6 by the time we get to the budget. The problem is that we all know we've got this fiscal issue and runaway government spending, et cetera. Getting that back under control requires taking very, very tough choices that are never going to win anyone any votes. So no politician is ever going to go down that path unless they are forced to by the bond market. And I think at some point, relatively soon, 12 months or so, you're probably going to see the bond market sort of force a bit of a reckoning on governments, I would imagine.
Gosh, that's something to look forward to. Well, I know you've got to run.
Well,
I know
I'm ending on a really rosy note now, aren't I?
no, but let's no. I mean, it hasn't been a very rosy few months. So I mean, it's the point. I think the point is for traders to understand. What's your main takeaway? You think for traders as they go into Q4?
Well, I think very much the main takeaway from the year so far is expect the unexpected. Certainly with President Trump in the Oval Office, trying to predict with any great degree of certainty what's going to happen next is almost impossible. I mean, my sort of biases are to be long dollar, long gold, long equity. They may change. They are very much subject to change depending on how developments evolve. And I think in terms of themes, it's very much a case of how much are the Fed going to ease and when do they get to the bottom of the cycle? And just taking it back right to what we were discussing at the start, this sort of fork in the road for the US economy, is it an adjustment where we're on the verge of a reacceleration into the back end of this year and the start of next year? Or is it the start of a more significant and more worrying rolling over in economic activity?
And if you're a betting man, which route do you think you'd go down?
I am firmly in the first camp for the time being, provided that the orange man doesn't do anything stupid.
Good luck. Superb. All right, Michael. I know we're pushing you over your time slot. Thank you so much for joining us.
No, pleasure. Thank you for having me.
It's been fantastic. Yeah, we really appreciate it, Michael. You've really given us a lot to think about. So we really appreciate it.
No, that's my pleasure. Thanks very much, guys.
Have a lovely weekend, and thank you all so much for tuning in. And Michael, we'll have you back on again soon.
Indeed. Looking forward to it.